Just he is India equity strategist with BofA Merrill Lynch, or BofAML actually. Sanjay, morning. Thank you for joining us. Why do you think NBFC stocks are getting smoked?
Good morning.
There is no risk to the debt market. There is enough
Well,
and more liquidity. Yeah, I mean, I guess you figured out my question, haven't you?
well, look, I mean, and you figured out the answer as well, I suspect, which is that, look, the market is suddenly concerned about two things. One is the impact of rising yields on their profitability, on margins, and potentially growth. And second, I suspect there is some fear on the solvency of many of these companies, which, frankly, we are a little suspect of going that far, I think. But my answer is that there is positioning. The Indian domestic market has been increasingly domestic driven, and within domestics, actually, the share of non-institutional domestics has been rising over the last 12 months. And when you see shocks like this, that is the problem. You don't see buyers come in as quickly. So while yes, there are genuine reasons to be worried about the margins and potential growth and multiples of these NBFC, the magnitude of the correction could also reflect the overpositioning that we had in some of these names.
Okay. What is the best way to judge the positioning? Across the board, NBFC stocks are down 15 to 50%. At what price point you would say, I'm going to be a contra buyer, markets are getting unnecessarily nervous. It's not for the first time in the history of mankind that interest rates have gone higher. It's a periodic cycle which happens every 4 or 5 years. The way markets are behaving as if this is something which has never happened in the existence of human race.
Correct. So the answer to that is not to look at the share price, but to look at the multiple. Okay, and this is what I keep talking to all who ask me that question, is that just because the stock is down 20% from peak does not necessarily mean you should buy it. Is the valuation multiple on it at a zone that you are comfortable with, given the near term and longer term growth projections for that company, whether it is an NBFC or a consumer stock or whatever it might be? The focus from an investing point of view should be what you're paying in terms of valuation multiples. Share price action in itself is not sufficient to justify that. Now, while we don't cover many of these NBFC, my suspicion is that even though you've seen the correction, the multiple may not be in a zone that makes you comfortable just yet, given the adjustments you have to make to growth and margins, at least in the near few years.
Sanjay, hi. Just trying to assess what's happening outside of NBFCs. I mean, is it time to now tread with caution in IT and pharma as well? Do you sense that's where you will see the next wave of dip coming in, assuming you do believe that the market is going to fall further?
Morning. So the first answer is yes, we do think the market has downside. There are a host of issues with it. There is an external environment which is changing, in that global liquidity started to withdraw, domestic uncertainties have risen and will probably worsen into the elections. So the noise around the political uncertainties will dampen domestic sentiment very predictably, I think. In that setup, I kind of flippantly tell my investors that, look, IT is what you buy in India when you don't want to buy India. Okay, that is a defensive positioning. It is not really a growth sector. It is not something that's probably going to go back to mid-high double-digit growth in any time soon. And multiples on those have exceeded meaningfully whatever their long-term averages could be. Now, in this environment, when the rupee is uncertain, I understand why a lot of investors are looking for relative trades in IT names. But should that argument go away, should the rupee start to stabilize, then there is actually very little reason for you to stay invested in IT companies.
Okay, very little reason to stay invested in IT companies. Sanjay, how are you looking at your investment strategy in this sort of a market environment where, while there was conviction about earnings coming back, perhaps helping the market re-rate itself, and we were talking about a level of 12,000 and beyond, now we are back into a zone of volatility. Of course, rising oil prices and higher interest rates in the US does not help the situation at all. So how do you look at your investment strategy in lieu of these changes?
Right. So look, we have been careful on the market because, at least from an external perspective, the tightening liquidity was very predictable. All the central banks had flagged their intention to raise rates and reduce the liquidity supply globally. and therefore we have been dollar bulls throughout the year, which is playing out. Okay, and very predictably again, strong dollar, strong rising rates in the US is negative for EM assets in India, is part of that, should we like it or not. Okay, I don't think that is changing unless we start to see significant change in trends in US data. The external environment is likely to remain as it is at the moment, and that means you will see further volatility in the country. Now, what also happens is that the rise in oil prices and the volatility in the rupee will translate to domestic consumption, right? If you're paying $15 billion additional to your oil supplier, there is no way that your disposable income will not fall by that $15 billion. So whether it is through lower volume growth or through lower margins at consumer companies, it will translate into earnings downgrades or expectations downgrades in India over the next few months. And that is going to be a problem for stocks which are super expensive. I mean, all consumer pack is trading at 45, 55 times earnings going forward. And if you start to see earnings concerns on these names, then the multiples may not hold. Okay. So again, this is a concern that is likely to play out. Another point I want to highlight is that earnings growth in itself is not sufficient. So we did this analysis a little while ago where we highlighted it that earnings beats are bigger drivers of stocks in the near term than earnings growth itself. So if you take the first quarter, June, we got 23% PAT growth if you exclude the financials. But even after getting that, we've still seen earnings cuts. So that's the problem. Expectations in the markets have become too high and they need to reset downwards before we start to see further upside.
So Sanjay, while you do believe that the market does have more downside, are you also revising your year-end targets? Purely looking at the kind of dynamics and the global setting that we are in, we've just heard from the Fair, while much looks on expected lines, you know, there's that slight caveat that they see global growth continue for next 3 years. What happens after 3 years is a big question mark.
So look, I have a pretty low fair value estimate for the Sensex as it is today. I don't think I have any further need to cut it down, if that's what you mean. And should I be increasing it? That depends really on whether I think the EPS is going to be higher than we've modeled, and I see no reason to do that. So yeah, I've stuck my neck out. I said 32,000 on the Sensex, and I got quite a few big bets for it, but I leave it at that. That's what I think the fair value should be.
When a selling like this happened in 2013, rupee went higher, rupee went lower, crude went higher. Money moved to consumers. Money moved to beaten down, butchered down mid and small cap stocks. So currently, what will happen? IT pharma have run up, consumers are expensive, NBFCs have their own bit of ownership issues, mid caps are expensive than large cap stocks. So where will liquidity move? Because it has to move somewhere.
Right, and the answer could possibly be the debt markets. Right, if you look at the FMPs today, they are offering 8.5% assuredly post-tax on a 3-year basis. Inflation at 4%, 4.5%, 5%. You're still making 3-4% real return locked in. Okay, and if you start to now see deposit rate increases because banks need to raise deposits, then that will be the way where money goes in. And you know, essentially, you need a risk-off in equity markets for the flow of money to slow down, which we're already starting to see, by the way. And I don't think that we should try and do the zero-sum analysis of where domestic savings will actually end up, because real rates in India have become pretty positive.
Sanjay, when the market does choose to recover, do you sense that there could be a leadership change? It may not be about IT, pharmaceuticals, NBFCs, 2-3 private banks, but an emergence of a new sector which could lead the market recover and then eventually higher from here.
Well, you would need a very large cap sector to move, frankly, just to answer that question. But I don't think I can predict that. And look, if you're saying that the market is going to get over these risks, then you are implicitly assuming that the rupee volatility will stabilize and the oil prices will no longer continue to go up, which by definition would mean that the IT companies no longer outperform. Okay, so yes, there will be rotation in that scenario, but ultimately you've got to look at where the earnings growth is likely to come from. Okay, and those are the stocks that will probably do well. I therefore recommend, in my investing sort of advice, is to stay with the retail financial banks, the large cap, those who have their own liability franchises, and stay with the potentially rural bias, because in this environment, the weaker rupee is actually good for rural incomes. It transfers consumption from the urban consumer to the rural producer. And of course, there is welfare and stimulus getting into elections. So on a relative basis, the rural related stocks probably would do well.
Even if they come at a price, especially the retail banks?
Well, nothing is cheap. Unfortunately, you cannot yet, despite whatever correction we've seen in India, find a large cap stock which you like at a multiple that you like. There is no intersection of the growth basket with the value basket, unfortunately, and that possibly needs to change. I need to see some good companies at a good price for let's say foreign money to start to come back to India.
Closing comments. What is the good news here? Last 15 minutes, we only discussed bad news.
Well, look, I don't want to be like that. I mean, those were the questions you asked me. But the good news so far is that the micro is improving. If you look at the last reported data points out of consumer companies, the growth, even if you adjust for the base effects, is actually headed up. If you look at the, let's say, the Li Keqiang indicators for India, the rail freight volumes, electricity demands, the hard numbers are improving. Industrial utilizations are going up. Now, the concern here would be that somehow this macro deterioration will dampen that recovery, and unfortunately that is likely to happen. But it is undeniable that the underlying economy has been improving so far.
For an equity investor, there are two options. You take a view that next 1 year, 1.5 year would be bad and terrible. Last 3 year CAGR returns have been strong. I should take my chips off the table. Or the second option is that I don't bother about election, I don't bother about rupee and crude, because if I look at the last 5 year, 10 year, 15 year, 20 year track record, it has always been triumph of an optimistic, and the more you stay with the equity market, the more chances of making money are there. So what should a sensible SIP investor do?
Precisely. The investor should be clear in her mind the time horizon of her equity investment. If they are being attracted to the equity market for short term gains, then clearly this is not the time. However, if there is enough patience, if it is clarity in the investor's mind that I am in here for the next 10 years, then frankly the entry price does not make too much of an impact. I still think that maybe if you wait, you'll make more return, but on a 10-year basis, that entry price really would not change the outcome too much.